And now to introduce our next pair of esteemed panelists, each one at the top of their profession. First, Stephen Adler, who is president and editor-in-chief of Reuters. As such, Mr. Adler heads the largest news agency in the world. Reuters employs over 2,300 full-time journalists on the ground in 200 bureaus around the world. Stephen's team delivers the news, photographs, video, and commentary to over 1 billion people a day. Before joining Thomson Reuters, Mr. Adler was editor-in-chief of Business Week, and prior to that, he spent 16 years at the Wall Street Journal, leading teams to 3 Pulitzer Prizes between 1995 and 1999. Please help me welcome Stephen Adler. Joining Mr. Adler is David Rubenstein of the Carlyle Group, a man who needs no introduction. David is the leader and public face of one of the largest, most diversified, and most successful private equity firms in the world. The firm has $170 billion under management across over 100 funds, and it has over 600 investment professionals located in 30 countries. Prior to forming the Carlyle Group in 1987, Mr. Rubenstein practiced law in Washington, D.C., and was also Deputy Assistant to President Carter for Domestic Policy. Please help me welcome David Rubenstein.
Thanks very much. Thank you.
Welcome again. Well, welcome, David.
My pleasure.
So delighted that you're here.
Happy to be here. Oh, it's early in the morning.
It is, but people are delighted to see you. Even though you can't see them, they can see you.
They are there, yes.
They are there, yes. So we just heard a fairly pessimistic view, at least of the U.S. economy and particularly U.S. equities. And we had another Thomson Reuters event a couple of nights ago where David Stockman was the key speaker. And of course, he just has a book out which is extremely negative about the economy. He basically says we're living in a Keynesian bubble and it's all cheap money and we're heading for a gigantic fall. And he recommends we all put our money inside the mattress, which is an alternative investment of a different kind than we're talking about today. What are the odds that that's true?
Well, in any given period of time over the last several hundred years, there are always people who say the world is falling apart, the sky is falling, and and occasionally they will, in some short periods of time, be correct. But you have to look at the longer period of time. In private equity, for example, you tend not to say, well, is something going to be good today or the next 6 months or 1 year from today, but how is it going to be over the next 5 years or 8 years or so? Given the fact that populations are increasing, that wealth is generally increasing, that the emerging markets are emerging, I would say generally it's more likely there's going to be greater wealth 5 years from today in the world than there is today. Yes, there may be occasional down periods, and yes, if you're very good at market timing, you may be able to get in and out at the right time. But private equity is not so much about market timing. It's about wealth creation by making companies better. And so I do listen to these kinds of stories from time to time, and from time to time I do realize that markets will go down, but it's not something that makes me lose sleep at night, because I realize generally in private equity what we're trying to do is create companies that are going to be more valuable over a longer period of time, and we don't try to market time quite as much. So, each of those speakers that you just referred to and authors are, maybe right on certain periods of time in certain areas, but as a general rule of thumb, I think that private equity people tend to be more optimistic about the future, and in my case, tend to be more optimistic about the future than, say, David Stockman.
Right. Okay, so let's assume we are, in fact, post-recession and not just imminently pre-recession, as
Okay.
Mark Yusko was suggesting. For private equity, so what are you seeing? Is this a good time to be, first of all, raising money, because you're probably the world's best raiser of funds, but also in terms of, is this an exciting time to be out there looking for investments?
First, the private equity market, I would say, had this so-called golden age between 2002 and 2007, when things seemed to be wonderful for everybody. Exits were great, distributions were great, deals were being done at a high level, and fundraising was pretty easy. Then when the recession happened, all of a sudden the world fell apart, and fundraising went down by 90%, deal doing went down by 80%, distributions went down by 70% or something like that. Today, we're now more or less, after the Great Recession officially ended June of 2009, so we're like 4 years after that. you now can see how the Great Recession impacted private equity. It changed us a lot. We are more resilient than we were before. Some of the firms that were weak did not really survive, but generally the firms pitched in, rolled up their sleeves, and made themselves stronger. Today, we are not back to the 2007, 2008 peak in terms of deal doing, in terms of fundraising, in terms of distributions, but we're coming back, and I think the trend is pretty good. What we now see as the major changes that have happened in private equity since the Great Recession are these. Funds are smaller, because investors want smaller funds. Deals are smaller. Fees are lower. There's greater alignment of interest between general partners and limited partners. The governments around the world have concluded that private equity is not a cause of systemic risk. They're generally leaving private equity alone. The taxation issues that have been discussed are not really on the front burner right now, so not something that people are as worried about in the industry as maybe they were before. And the emerging markets are getting much more capital and attention than they were before. And you see the United States dominating this business. There are maybe 5,000 private equity firms in the world. The United States, though, has the only 7 that are truly global and that are really able to really raise money all over the world and invest money all over the world. That probably will change over the next 5 to 10 years. But for the next 5 years, these 7, which I would say are Carlyle, Blackstone, TPG, KKR, Apollo, Bain, and Oaktree, all with $75 billion or more under management, are likely to continue the same strategy of having multiple funds, diversifying their base from just one area, and using their brand to try to raise money in different areas and also to get deals done in different areas. Between now and 5 years from now, it will be difficult for somebody in China, India, Brazil, Middle East to raise a fund that's big enough, an organization big enough to compete with those 7. But I'd say 5 to 10 years from now, there probably will be a global private equity organization based somewhere not in the United States. It's hard to believe if we're only 20% of the world's GDP, we can be at 100% of the global private equity firms. So that will change. But over the next 5 years, I suspect America will still dominate this business.
Just in terms of kind of trends in private equity, I was just wondering if there are lessons to be learned from what's going on with the Dell deal. I mean, sort of capturing a moment in time as to kind of how the world looks in the private equity arena. Can you comment at all on what's happening there? And
well, I guess I can because I don't have any knowledge about it, and therefore
please feel free.
I don't have any inside information. In my view, well, I got probably in trouble with the deal. I was in Davos, and I was on some TV show, and they asked me about this deal, and I said, well, the history of private equity deals with $20 billion or more in market cap is generally not replete with a lot of success. And I thought that was a really accurate observation. About 10 minutes later, I had to go to lunch with Michael Dell. He wasn't thrilled to hear that, but anyway, it is true that these large buyout deals have not generally produced spectacular returns. So if you take a look at all the deals that have been done at $20 billion or more over the years, how many of them really have doubled the investment equity? So probably TXU would not be a double of invested equity, and probably RJR would not be a double of invested equity. So you have to realize that when you have this much equity involved, it's very difficult to get the kind of rates of return that you want. On the Dell deal, I don't think it's indicative of a trend of $20 billion buyouts about to happen. This is a unique situation where a CEO owns 15% of the company. He more or less wants to take it private, and he has the capital to put additional money beyond his 15% in. I don't think there's a lot of those situations out there. I think while deals of $10 to $20 billion or even $30 billion were not unusual between, let's say, 2004 to 2007, today I think something around $5 to $7 billion would be probably the more normal limit. There will be occasional deals that are higher than that. One of the changes in the large deals that might get done, in other words, there might be some deals done above $5 billion and maybe not as big as $20 billion, but 5 to 10, 15, is probably that you won't see as many private equity firms teaming up with each other as you did before. It's unlikely that you'll see 5 private equity firms coming together as they did in the past. And the reason for that is that today, what investors want is to co-invest. They really want to go into a fund, but they really want to co-invest additional capital, no fee, no carry. And since so many large investors have that interest, they are now going to GPs like us and say, if you have a big deal, don't call up one of your brethren in the private equity world, call us up. And that's what you're going to see more of. So if there are larger deals, it probably won't be 5 or 6 private equity firms going in together as they've done in some deals before.
Is the antitrust case anything of a deterrent to that? I know there's a Boston federal judge let the big case go forward a few days ago. I mean, is that something that's causing people to stop and think about doing club deals?
I don't think that's a big factor. I think the biggest factor is that you have investors who are putting money in your funds, and they're saying, well, we don't really want to put all of our money in your funds. We'd like to reserve some for co-investment where we can pick the deal and where we have no fee and no carry. And I think that's a driving force.
Yeah. Okay. And by the way, David is very happy to engage with the audience, and so we'll reserve 15 minutes or so because I suspect you'll have lots of questions for him, just so you can prepare and think about those questions.
Okay.
We heard and have heard a lot about the U.S. and Europe as being obviously real problems, at least many people think they are. I gather that's not your view, at least from a private equity perspective. And I wonder if you could talk about each of them, about how you see the U.S., the economy, manufacturing, the kinds of investments. And of course, you, as well as most of the other so-called traditional private equity firms, have diversified into other kinds of investments. But I mean, looking at the U.S. and then looking at what opportunities you see in Europe.
Well, again, we tend to look at things at 5 to 8 year perspectives. So people often ask me, is it a good time to invest in private equity? Well, in any given time, that particular day, it might not be good or it might be good, but we tend to look at longer term circumstances. So even if today it might not be wonderful to go in, we wonder whether or not it's a good thing to base your decision on whether it's good today, because you're really looking at whether you can increase the value of a company over a long period of time. But as to your question, the U.S., in my view, is without doubt the greatest place in the world to invest in private equity or any place else, in terms of non-private equity as well. In terms of private equity, you have the rule of law, you have transparency, you have the best infrastructure for doing deals, low interest rates, the quality of managers, the ability to exit. It really is not replicated any place in the world. So even though our growth rate in the United States this year, best case would be 3%, and 3% GDP doesn't mean necessarily the deals are going to be spectacularly successful, all the other factors I just mentioned makes it so much easier to do deals and better do deals, risk-adjusted in the United States, that nothing else is even close. Europe is what I call the largest emerging market in the world. It's been beaten down so much, even though it's the biggest economy in the world, it's been beaten down so much that people have shied away from it. A lot of the American private equity firms that went into Europe in the early part of this century have now reduced their workforces there or not really doing deals there that much. So there's actually less competition in Europe than there used to be, at least from the American firms. And some of the large European firms have gone away or are not able to raise the funds that they once were able to. So there's probably less price competition than there was before and less deal competition. Therefore, I think it's pretty attractive. I also think that if you can find a European financial institution which is hard-pressed to sell assets, particularly if the assets are outside of Europe, you're going to find a pretty good deal. Many of the European banks were thought to be unloading enormous amounts of debt a couple years ago, and people got ready for this, but I call it waiting for Godot because it never really showed up. There wasn't a massive sale of assets by European banks, and the reason was the European banks, if they sold all the assets at the prices they would get, would actually have been bankrupt because they were just undercapitalized. That situation isn't so prevalent now. Now they're better capitalized because of Basel III and other things, and therefore they can sell assets at really the market prices, though the market prices have come up. So you're going to see banks selling assets, not in gigantic waves, but occasionally assets. I think there's probably pretty good opportunities. So we do think Europe is a reasonably good place to invest, but you have to recognize that the growth rates there are not even going to be what the United States is going to be. Growth rates will be anywhere from 0.5 negative to maybe 0.5 positive. So modest growth rates, so therefore you really have to get pretty good pricing going in.
Right. And Carlyle has been buying distressed assets in Europe. I think I read that, right?
Well, we have,
Right,
for example, one French bank sold TCW to us and to 2 of our funds, and it's an asset that's really in the United States. It was a fixed income money manager, and they had it on its books for well above what we paid for it, and we think it's a very good asset, but it's typical of what you're now seeing. European banks and other institutions are unloading assets that they can now afford to sell. They're getting a lower price than they probably carried on their books, but it still helps them for their Basel III requirements.
Yeah. But you do seem to be betting, I think, tell me if I'm wrong, that the European Union will stay together, that there is a robust future out there for Europe, even if there isn't a near-term robust future.
I'd say a year and a half ago, maybe 2 years ago, but certainly a year and a half ago, maybe a year ago, people would have said, well, the euro is not certain to survive. I think today we now believe the euro, and I think everybody believes the euro will survive. There may be one or two countries that may not survive as part of it, but no one is saying today the euro is going to fall apart. I think the Germans in particular and others in Northern Europe and the French have concluded that the euro is the best thing for Europe. And I think it is a very good thing for Germany. Without the euro, I think the German economy would be in much worse shape because Deutschmark would be very high. They wouldn't be able to export the way they have. I believe that the euro, because of the ECB statements and other things saying they would protect the euro, is going to be around for a while. The EU will not break up. I don't believe that it's likely that that UK will get out. There is a talk about a vote in 2017.
Right.
Well, that's down the road. And I think the Prime Minister said if he was reelected,
Right.
well, you know, he has to get reelected, and once he's reelected, you know, we'll see whether the vote would occur. There was discussion many times in Europe about voting on whether they would go into the euro, and those votes never actually happened. So you have to wonder whether the vote that's theoretically going to happen in 2017 would actually happen. I suspect there'll be some negotiations between the UK and the EU before then that would probably keep the UK in the EU.
Are you looking at Cyprus as a place to make some distressed investments?
I don't think Cyprus is a place where there's a lot of great private equity investments for firms like us, but the most important thing about Cyprus is this. You know, Cyprus is 0.2% of the EU's GDP, so it's insignificant. So why is it getting this much attention? Well, in part because whenever there's a calamity, the press like to focus on it, maybe understandably so. But the real thing that has resonated around the world is that for the first time, people realize that governments can come in and wipe out your bank account. People's bank accounts are generally viewed as inviolate. You have your money unless you go to jail or you've done some criminal thing where the government can freeze your account. Generally, your bank account is your bank account. But people woke up one day and said, wait a second, the government can come in and just swipe out 10% of our bank account as a tax. People didn't realize the governments could do that or would think of doing that. So that scared people, but not in Cyprus so much, but everywhere else in the world.
Right.
So even in the United States, people were beginning to wonder, well, could the government do that to me someday? Now, it's unlikely that would ever happen here, but the idea that the government could just push a button and all of a sudden 10% of your bank account is wiped out is something that scared people, and therefore it's going to resonate around the world where people are going to maybe move money out of certain countries which are not all that strong. So if you're in a bank that's not all that strong, in a country that's not all that strong, you might not keep your money there any longer. So that's the real impact of Cyprus, is scaring to death a lot of depositors around the world.
Right. So moving away from U.S., Europe, you and Carlyle were very early to China. You know a ton about China. You go there a lot. And I think there's a lot of interest in getting your insight into the new leadership, how you see it as an investment environment going forward. Is the growth going to be sustained? Are they going to have social unrest issues? Just how do you see it?
I think next to the United States, to me, the most attractive place in the world to invest has been for the last 5 years or so and will be for the next 5, 10, 15 years or so, China. It is going to be the biggest economy in the world in our lifetime. The growth rates that people obsess over, whether China is going to grow at 8% or 8.5%, is a silly debate when you consider that we're going to grow at 2.5 to maybe 3%. No other country in the world has grown at 10% a year for 30 years in a row in the history of the world. And now China will probably grow at 8 to 8.5% for quite some time into the future. So given the size of the population, given the entrepreneurial nature of the people there, 1 out of every 10 adults there is, by some definitions, an entrepreneur, the highest percentage in the world, people who have started their own businesses. And therefore, I find it to be much more capitalistic in its outlook than many other countries, including in many ways the United States. If you go to Congress and talk to members about the capitalist system, sometimes they look at you like you're from another world. If you go to the Chinese government leaders and talk about the values of capitalism and what it can do for their economy, they're very, very interested. And that's because they realize that private equity and capitalism has a lot of benefits despite their ideological points of view historically. Given the opportunities in China, we would say it's a great place to invest. Remember, all the investments that have been done in China to date are mostly in a couple of large cities on the eastern part of China. The central part of China and the western part of China have been virtually untapped in terms of private equity opportunities. You also find that financing is available if you want financing. You also can find that you have terrific managers, very young entrepreneurs who are people you feel comfortable backing. So we have about 12 to 13% of our entire workforce around the world in China, all Chinese natives. I spend a lot of time there. My other senior partners spend a lot of time there. So we're very attracted to it. Now, the Chinese leadership. I have the view that the previous Chinese leadership may have been not as adventuresome as the current one. The current leadership their parents were revolutionary leaders, and therefore they're so-called princelings, and therefore they have, I think, more self-assurance about their position in the world, and they aren't as, I'd say, as bureaucratic, and therefore they're willing to take big initiatives, and they have much more self-confidence. I think when the current president of China, before he was president, came to the United States, the U.S. leaders with whom he met in Washington were extremely impressed with his ability to talk without notes, to really talk with a great deal of self-assurance about what he wanted to do with China. So I do think that the Chinese economy will grow at a greater rate than it probably grew last year, and we do think it's a very attractive place in which to invest.
So what keeps you up at night on sort of what's going on in the world? What are the biggest risks? So you have a very successful investment company, you're diversifying, you just went public, you just did your IPO.
Right.
What are kind of the really worrisome scenarios? Is it North Korea? Is it Iran? Is it some global financial crisis? I mean, what do you see as a big risk factor?
So two categories. One, two overarching risks that you always have are macroeconomic factors. You know, right now we have recessions in the United States roughly every 7 years, and they last on average roughly 9 months. So we had our last recession that theoretically ended in June of 2009, and maybe in a few years we'll be due for another recession. I don't really think we quite got out of the last recession. Right. We measure recessions by 2 consecutive quarters of negative growth, but probably we should measure them in other ways, because when the unemployment rate stays as high as it did, it's probably not fair to say we were out of the recession. But let's suppose we're really inching out of this recession, last recession. You know, you could go back into some kind of macroeconomic downturn around the world, and macroeconomic factors are much more significant to private equity than they used to be. Historically, private equity people did their deals, and they didn't worry that much about global macroeconomic factors. Now, we have economists in our firm. Many other firms like ours have economists. We spend much more time worrying about macroeconomic factors than we did before. So if there was an overall macroeconomic meltdown, that would be a problem. Problem number two is regulatory. Yeah. You know, as Ronald Reagan once famously said, the most dangerous words in the English language are, "I'm from the federal government, I'm here to help you." Right. And so, you know, when governments come along and they say they want to help you, you have to be careful. So whenever government's thinking that they are going to do something that's going to make the investment system or the economy better, you do have to be a bit nervous. So I always worry about regulatory factors, but not just in the United States, but anywhere in the world. Particularly in some emerging markets where if private equity firms from outside the country come in, they make money, they make too much money in the view of the local people, the regulators come in and say you did something wrong. Right. So that's always a factor. But leaving those aside, those two overarching macroeconomic and regulatory factors, I would say there are certain event-driven kinds of things that could be a problem. One, is there going to be an attack on Iran? I suspect there will not be, but that could be a problem. Two, will there be some problem in the Middle East between the Palestinians and the Israelis? I suspect not for a while of any great consequence, but you don't know. Three, Syria. Could Syria you know, just get out of control and there have to be more intervention than there has been to date? You don't know. Fourth, North Korea and South Korea. North Korea is saber-rattling a bit. The United States is very worried about it. We're doing things that are trying to make clear that we're involved and concerned about protecting South Korea, but you don't know whether that would get out of control. Japan versus China, they're fighting over some islands. They're not fighting, but they're talking about the concern about these islands. You don't know whether that would escalate. We haven't heard from Pakistan and India in a while. Those problems could arise. So, you know, all those things are potential problems. I would say none of them seem to me as big as likely to happen in the near term as maybe people were worried about a year or so ago in some of those cases. So I think generally I don't see these kind of event-driven things causing big problems. But you have to remember, no one ever accurately anticipates the problem that causes a macroeconomic concern. No one probably really anticipated the subprime mortgage crisis the way it ultimately arose, or the EU's problems with the euro. So I don't know that we can perfectly predict what will be the case. All that we can say is that between now and 2 years from now, something will happen that we didn't anticipate, right, and it will cause greater concern than we thought it would.
Right. Okay. Fine. So this conference is on alternative investments broadly, not just private equity. And as we discussed earlier, you know, most traditional private equity firms over the last few years have really diversified fairly aggressively, as have you. So you have a real assets division. You right, care about real estate. You care about energy, natural resources. Talk to us a bit about that. What are the areas you're most excited about, and why have you moved past private equity into these broader areas?
Well, first, private equity firms are no different than other businesses. As they grow, they say, okay, we did very well in one area, but maybe we should be in another area. So if you observe all companies, they always do this. Microsoft was very good in one area. Initially, it was software, but then they got into Xbox and they got into other kinds of things. Apple was essentially a computer company, and then they diversified and got into phones and so forth. So all companies are always worried that their key business will ultimately get competition, will be less profitable, the margins will go down as more people come in, and as a result, they try to diversify. Private equity firms are doing that now. Now, there's no way to really know exactly how these private equity firms are going to go into the future in terms of diversification because there's no real history. If you go to Harvard Business School or Stanford Business School or any good business school and say, give me a course on how to manage a global private equity firm, there's no course and there's no book because we're all kind of finding our way for the first time. All the large firms that I mentioned, the 7 that I mentioned, are basically adopting the same strategy. Take advantage of their brand name, make sure their brand name is well known, and do what people do who develop very good brands, not just in private equity. That's just to say, have different products. And the theory that if your customer liked you in product A, they might give you a chance in product B or product C, and if you can get your customer to do that with you, you're probably going to build a more solid business that isn't dependent on any one area. There's nothing wrong with that. Private equity is a business that is episodic. From time to time, it's easier to do it than other times. So firms like ours have basically said, well, we have good investment skills and good professionals, and they can do similar things in other areas. So they could do real estate investing, they could do energy investing, they could do hedge fund investing, and so generally we've tried to build expertise in different areas. But this is not for everybody. Most of the private equity firms in the world are basically focused on one thing, which is one area. Let's say there are 5,000 private equity firms in the world. 99% of them are basically doing one fund, and they're probably doing it reasonably well. That's the way the private equity business historically was. It's only in the last 10 years or so that a number of firms have decided to basically build them brand names that are global and have multiple products, and that's not for every investor, but for some investors I think it works because some investors say, I can't chase down who are the best private equity firms are going to be in any given area at any given time, but if I go with a brand name firm, it's likely that they'll do reasonably well, and if there's a mistake, they have the resources to fix it. And it's not unlike the old saying, you can't get fired for buying IBM. Right. Presumably, you can't get fired for investing in company A or company B if it's one of these brand name firms because they're probably going to do reasonably well.
Yeah. Does the IPO force you towards a slightly more short-term horizon or to do more of a mix between long and short?
Well, the obsession that some people had about private equity firms going public was that they would do that, but there's no evidence so far that the private equity firms are as short-term oriented as people thought they would be, or that there's a conflict between the investors and the unit holders. Generally, in our case, we've told people we run the firm for the investors, and if you don't like that, don't buy the units because we're really obsessed over the investors, not the unit holders. And if we do well for the investors, the units will take care of themselves, and so far it's worked out. So we have quarterly calls. I'm on the quarterly calls. We give the earnings statements, but we're not really obsessed with the earnings each quarter because we think ultimately people are buying us for dividend yields and for longer-term plays.
Okay. I suspect there'll be more financially oriented questions from the audience.
Okay.
Before I go to the audience, I just want to ask you about one thing that's more personal. So you relatively recently made the Bill Gates pledge to give away 50% of your wealth, I suppose.
Right.
Why did you do that, and kind of how do you see kind of how much philanthropy becomes part of your mix of things you're going to do going forward?
Look, I came from very modest circumstances. My parents were not college or high school graduates. My father never made more than $7,000 a year. I got very lucky in my business career, and I felt that I owed a lot back to this country and the community that made it possible for me to do this. So I decided that I would, before Bill Gates called me about it, I decided I was going to give away the bulk of my money, in part because I wanted to repay the country that had been so good to me and organizations and causes that I thought were useful and helpful, but also it's not clear to me that giving one's children hundreds of millions of dollars is necessarily a great way to treat them, although my children don't necessarily agree with that. I'd say, how many people have won Nobel Prizes after they've inherited $100 million or more? Probably very few. The people that do the great things in society are often people that came from relatively modest circumstances or middle-class incomes, not from very wealthy families. And so I think you can take away the ambition of your children and really do damage to them by telling them, okay, you're going to get $500 million, you don't have to work that hard. So my view was to not give my children very much money. In fact, the Giving Pledge more or less says you're going to give away 50% of your money during your lifetime or at the time of your death. Now, if you don't give away any money at the time of your death, you're supposed to give away 50%. But if you die and you haven't given away, well, there's no way that they're going to take you out of the grave and penalize you. So there's no real penalty to this pledge. It's really a voluntary thing. In my own case, I would probably opt to give away 95% of my money or something like that. So there's no reason that you can't give away more. In fact, Bill Gates is going to give away the bulk of his money. He's going to give his children very modest amounts of money. And now we've got about 100 people around the world who've signed this pledge. And it's really designed not so much to say we're wealthy people and we're going to be able to give away a lot of our money and our lifestyles aren't going to be affected all that much by it. It's really designed to say people that have made a lot of money do have some obligation to society to give back if they can. But I don't care so much about the wealthy people giving away the money. I care more about the people that are not as wealthy. And so I got involved, and my statement when I signed the Giving Pledge was designed to say, I hope that the inspiration is for average people who have average incomes to give more than they have given before. And when I also try to remind people that philanthropy is an ancient Greek word that means loving humanity. It has nothing to do with billionaires giving away cash. It means you're helping other people. And you can do that by your time, your energy, your ideas. And so the greatest philanthropists are not really people that write the biggest checks, but they're people that come up with very good ideas to change society. For example, Wendy Kopp came up with the idea for Teach for America. That's a terrific philanthropic endeavor. It's called a social entrepreneur effort now, the way we categorize things. But really, it's a terrific philanthropic endeavor for which she didn't have a lot of money to put into. And I think many people who have good ideas like that are great philanthropists, and we should encourage everybody in society and not wait until they got to the age I did when I started doing it in my 50s. They should do it when they're in their 20s, 30s, and 40s. I think the younger generation recognizes that, and increasingly we're seeing younger people make philanthropic gifts that are outsized compared to their age. Normally, you wait for people to see, you see people in their 50s, 60s, and 70s saying, okay, I can't be buried with this money, so I have to give it away. But now we're seeing people younger than that actually giving away money or doing the kinds of other things that are involved in philanthropy. So that's why I did it, and I'm very happy to do it, and I wish that other people would do it as well.
Thank you. Let me turn it over to the audience. I will have more questions if you don't, but I suspect you'll fill the rest of the time very productively. I don't know, but do we have microphones going around, or do people just get up? There's a microphone back there. I can't see anybody because the lights are so bright, so you're going to have, somebody else is going to have to manage this. Okay. Whoever's got the microphone, feel free to go ahead.
Is it working? Good morning. I think you would agree that the developed world is awash with debt, and the global need to seek growth to try to counter that. And you seem to be optimistic that that growth will be derived from the emerging world, from China. And I guess the question I have is, the emerging markets depend on the developed world for their growth. I mean, most of them are very much export-oriented. So how can you be so confident that they'll be able to grow through their own internal consumption? That's my question.
Okay. Well, first, the phrase the emerging markets was invented more or less in 1981 by Antoine Attal, who basically came up with that phrase. He was trying to raise a fund that was called a Third World Fund, and people thought that was a pejorative name, and he ultimately came up over a weekend with the phrase emerging markets. And emerging markets kind of was only supposed to apply in his time to about 20 countries. Now it applies to most countries in the world except the United States, Western Europe, Japan, Australia, Canada. Today, this year, in purchase price parity as a way to measure wealth, we will this year for the first time have the emerging markets GDP surpass that of the developed markets, so-called. And so you're seeing a transformation in the global economy where wealth is really going much more to the emerging markets and where growth is likely to be much greater there over the next 10, 20 years or so. So there's no doubt, you're correct, that the emerging markets sell a lot of products to the developed markets, and if Europe and the United States stopped buying things from China, China would have severe problems. However, I think the emerging markets are increasingly recognizing that being so export dependent and so dependent on the developed markets is not a good thing. The developed markets are having age problems, demographic problems, they have debt problems, they have other budgetary problems, and so they're not going to be as good a market in the future as they have been in the past. And therefore, the emerging markets that are able to control their economies or do something about it, or trying to get their economies to shift much more to domestic consumption. It won't solve all the problems. You can't overnight take an economy that makes 70% of its GDP exporting, as China does, and make it 70% domestic consumption. It will take time. The reason I'm reasonably optimistic, though, generally, is that my view in private equity is that you're making investments in companies where you have 4 to 6, 7 years to effectuate a change, and therefore you have the opportunity to make companies more efficient than they were before. If I was a trader and I was only trading and trying to guess where the markets are going to be tomorrow or 1 month from today, I would probably be less optimistic about the ability to make money in the business that I was in. I think when you're in a business where you can control the company and you can change the management, you can direct the strategy, change the tactics of the company, I think you have a better chance of getting a reasonably good rate of return. The reason the private equity business really exists is not because of the charm and good looks of the founders of these firms. We know that. It really exists because people have observed over the last 5, 10, 15, 20, and 30 years that if you go into private equity, generally you'll outperform public equity in the same vintage period of time in over every market in the world, but maybe not by a dramatic amount, maybe by 300, 400 basis points. Not so much so that you would put up with the illiquidity or the high fees and so forth, but it's because people believe that they can pick the top quartile fund in any given vintage year or vintage period that they go into private equity because the top quartile funds outperform by an average of 2,000 basis points. So if you can find in any given vintage period of time the private equity organization that's going to outperform the public markets by 2,000 basis points, that's worth a lot of time. And that's why people go into these markets and go into these funds, because they think that the private equity outperforms. What we've learned through the Great Recession is that all forms of investment have their troubles. Nothing is perfectly uncorrelated with markets going down. Even though hedge funds are supposed to be uncorrelated to markets, to some extent they really are. Private equity is completely correlated to public markets. But what we've learned after the Great Recession is that private equity probably outperformed any other investment class over the last 4 or 5 years by almost any measurement, including measuring most hedge funds. And so that's why people are now coming back into private equity, seeing that it's probably, through good and bad times, a pretty good time, a place to invest. Though obviously there are going to be some deals that don't work out and some that work out very well. But if you take a look at the 25 largest deals done at the Great Recession, right before the Great Recession in private equity, a couple of them didn't work out, but most of them actually did and turned out to be pretty good. So people have observed that while there are ups and downs in the economy around the world, and you can't obsess over whether the markets are going to be up or down this month or next month, generally if you invest with pretty good private equity firms, are pretty experienced, you'll generally do pretty well if you have the patience to hold on to your investment for 4 to 6 years.
Okay.
David Toll, editor over at Buyouts Magazine. David, it's been about 5 or 6 years now since Carlyle and several other large firms formed the Private Equity Growth Capital Council. And I wonder if you could give your thoughts on how it's evolved since then and the impact it's had on the private equity market and where you see it going.
Okay. The Private Equity Council was initially set up by probably the larger firms in the industry, and it was originally set up to be kind of an educational think tank, give good information about and give more data about what private equity is doing. But from the time it was set up, the fight over carried interest took hold, and it became almost a full-time lobbying operation for many, many years to deal with the carried interest issues. Today, the council has changed. We now have called the Private Equity and Growth Capital Council to reflect the fact that it's not just large buyout firms, it's smaller firms as well, and they're not as full-time oriented just worrying about carried interest, so they're doing a better job in explaining what private equity is all about. I think private equity's biggest issue, and I should have referred to it earlier, is that the image of the industry is not as good as we would like. We have a higher probably public approval rating than members of Congress, but their rating is pretty low. So it's not really a high bar. I wish that the private equity industry could do a better job of explaining what it actually does to create value, but we haven't really done a very good job of that. Venture capital people are much better than we are, and when they go to Capitol Hill, they are able to tell members of Congress, we created these jobs. And in fact, maybe they did create jobs because the companies tended to be starting from new. Private equity doesn't really have a very good set of numbers about how many jobs we've created, because very often what we're doing is we're saving jobs. In baseball, they invented a statistic many years ago called saves that a relief pitcher would have. He didn't have wins, but he had saves. We don't really have a good statistic for how many jobs we prevented from being lost by turning around companies, and therefore people often think that all we're doing is quickly going in, trying to make a profit, and leaving a company worse off than it was before. That isn't the case, but that's no doubt the image that we have, and the recent presidential campaign didn't help. I think the Private Equity and Growth Capital Council has done a pretty good job, but you have to remember, in Washington, it's hard to get anybody's attention. There are 38,000 registered lobbyists, and it's hard to kind of get your message above everybody else's. So I think it's done reasonably well, can always do better. I hope that it isn't seen only as a lobbying organization, but it's seen as an educational institution as well, and that's what we have to do. A much better job of explaining to people what private equity people do that actually makes society somewhat better than it was before. And that's one of the things we've probably not done as well as we should have.
I'm afraid we're largely out of time. A quick last question. What's next for you, or is it Carlyle forever?
I did announce recently that I would follow the Pope's lead and retire when I'm 85. So I probably will at 85 retire, but probably not before then.
Okay. Well,
All right.
we're glad you're staying in action
Right.
for that long period of time. Thank you very
Thank
much.
you.
It's always great to hear from you.
Thank you.
David Rubenstein.